a lot of people who might fear that they have missed out on this rally with April being as strong as it has been. Should they? Should they be afraid that they've missed out?
Yeah, it's a great question, and I think investors have been trained almost to buy now and ask questions later, and I think that's exactly what's going on. And to your point, in the lead-in, we were talking about a lot of economic data preceded by the words worst since, and then a lot of price action that's actually being preceded by the phrase best since. So it's not a rule that the economy and the stock market have to align, especially in the near term, but I think a lot of folks are starting to think, wow, what does the stock market know about the future of the economy that we don't? And that's starting to draw them in as we're talking about reopening and things of that nature. I think the reality is the stock market often doesn't know that much more about the economic future than really anyone else, especially when you're thinking about leading economic indicators. Usually the stock market bottoms alongside leading economic indicators. Every major bottom we've made since the financial crisis, you go back to 11, 15, 18, stocks have bottomed in the same month as leading economic indicators. So the question we have to ask ourselves today is, do we believe leading economic indicators have bottomed or not? I think it's possible, but our guess is no, that they haven't. So we want to be cautious here. We think the market's going to have to take a bit of a breather. We're always long the market. That's how we invest for our clients. But we actually have used this rally above 2,800 to take a little bit of risk off the table. I think just as prudent managers of risk, you have to do that right now, given all the uncertainty out there and all the economic data that we're seeing today and that I think we're likely to see over the next number of months.
You know, that's very interesting, Jeff, and I'm so glad to hear you say that because, frankly, in my own personal portfolios, that's what I've done as the market has come back. I've not delevered, but de-risked a little bit in my own personal portfolios as some of that. I didn't sell at the bottom, thank goodness, unlike the last time. Richard, let me get you to react to what he just said, what Jeff just said, and talk about that. Is it better under these circumstances to be a little too late rather than too early?
Well, Tyler, yes. The answer is surprising. The answer is yes, it is better to be late than to be early. I mean, look, the opportune moment is to catch the market's bottom at the bottom. That's clearly the best point. But if you had to choose between being 6 months early or being 6 months late, about 70% of the time, take or leave a little bit there, but about 70% of the time, it pays to be 6 months late. And the reason why, and what people are ignoring is everybody says, well, the market bottoms, 3 to 6 months before the fundamentals bottom. That's correct, but that's not the analysis that you want to think about. You want to think about, when did investors think the market was bottoming? And that you'll find that there are plenty of head fakes and plenty of false starts and that sort of thing. So it pays to follow the fundamentals, to use the fundamentals as your divining rod, and watch the fundamentals. So what you really want is you want fundamentals improving and complete disbelief. I don't think that's what we have right now. I think we have fundamentals deteriorating and everybody's fear of missing out.